Did you know when oceans bloom, Earth cools? I'm Phil Cahill, founder and CEO of Ocean-Based Climate Solutions. So why ocean-based? Well, the ocean area is 360 million square kilometers, much more than the land at 148. So the oceans are where the action is to reverse climate change. And we have a technology that can do that. It's a wave-powered upwelling and downwelling pumps. Rides the ocean waves, brings up deep water from 450 meters, loaded with nutrients that triggers blooms of phytoplankton. They absorb CO2, and then they die, and they sink to the seafloor. It's called the biological carbon pump, where they get eaten and pooped. Downwelling directly transfers high CO2 surface water below 500 meters, so that supplements the amount of sequestration. This unit is very simple, automatically deployed in the open ocean when it's dropped off a boat. Just two moving parts and 20,000 tons lifetime CO2 sequestered. So how would it work? Well, with widespread deployment, we think we can bring atmospheric CO2 under 300 parts per million by 2100. And there's some great co-benefits. Cooling of the upper ocean, more oxygen, helping the fish populations, great amount of data for the ocean scientists, creating jobs, of course, and we'll be also developing a sea level rise adaptation fund using a portion of the profits from this technology. Our market and marketing is to go to large public corporations, multinationals. They can eliminate their footprint within 15 years with this technology. They can pay in cash or in their listed securities. We call it stock for carbon. Here's an example of Fordham. The European utility. Its emissions under business as usual without our technology will go off the chart, over 200,000 million tons by the end of the year, 200 million tons. And with our technology, they'll become net negative by 2035. And how would that compare if they had to pay with our technology zero cost versus if they had to absorb a carbon tax such as proposed by the International Monetary Fund, IMF, $75 a ton in 2030 and more after that. Well, with the carbon tax, their working capital, current assets would go net negative by $20 billion. So it's expensive, and paying for a tax to remove carbon is not necessarily the best way to do it. So there's also these PR benefits. Do well by doing good and look good while doing well. Here's the case studies that we've done showing the savings of our technology versus a carbon tax. 20 some odd different companies. As you can see, it ranges from 50% up to almost 90% savings to use our device. And what about the shareholder break even? If they pay under stock for carbon, they'll have to issue more shares. Well, if the price goes up at the end of the 15-year period because they have a higher ESG, then the shareholders get their money back. The market cap is recovered. And you can see for most companies, it's less than 20% break even for shareholders, the price increase at the end of 15 years. So if you'd like a no obligation analysis, similar to what we just showed you, please get in touch. And meanwhile, I hope you have a great Economist Sustainability Week.